It's late March 2026, and the global economy is staring down the barrel of what might just be the greatest challenge in recorded history. Welcome to The Explainer. Today, we're going to unpack a perfect storm of crises that are all hitting at the exact same time. So let's just dive right in with a really important question. We're used to dealing with one big problem at a time, right? But what happens when 9 massive global crises don't just line up, but actually slam into each other and ignite all at once? To really get what's going on, you've got to understand this one key concept, the systemic multiplier. Now, this isn't like dominoes falling one by one, no. This is more like one single event hitting a critical nerve center, sending shockwaves through totally different systems. We're talking energy, industry, finance, and making the damage everywhere else exponentially worse. As of right now, the world is being hit by 9 of these shocks simultaneously. And they're interacting in ways that, frankly, our standard risk models were never, ever built to handle. And what's really fascinating here is that one single geopolitical event is the main catalyst for this whole mess. The closure of the Strait of Hormuz has essentially pulled 20%, a full fifth of the world's traded oil right off the market. And as you'd expect, prices have just skyrocketed. But believe it or not, the oil shock is just the beginning. And its first and probably most surprising casualty is something that almost nobody saw coming: the global supply of helium. You see, it turns out that the very same waterway that's close to oil is the only export route for Qatar. And as you can see, Qatar produces nearly a third of all the helium in the world. With the strait shut down, all of that supply is now completely trapped. And look, we are not talking about party balloons here. Helium is a gas that you just can't substitute. It is absolutely vital for manufacturing the world's most advanced semiconductors, for running MRI machines in our hospitals, for aerospace, and even for making fiber optic cables. So this one disruption creates this huge immediate split. On one side, you have the handful of companies that control the rest of the world's helium. Their value is soaring. But on the other side, you've got tech giants like Samsung and TSMC facing potential shutdowns because they simply can't get this one critical gas. Okay, so let's pivot. We're going to move from a physical supply chain to the financial system, because another much quieter crisis is brewing in a part of the market that has just exploded in size over the last decade or so. We are talking about the private credit market. Think of it as a massive $1.8 trillion shadow banking system that loans money to companies. And right now, that entire engine is showing some serious signs of stress. And this chart, wow, this really gets to the heart of the problem. Normally, if a company can't pay back its loan, that's a default. Simple. But look at this. In the past year, a staggering 94% of these situations weren't called defaults. Instead, they were distressed exchanges, which is basically just restructuring the debt to pretend the problem isn't there. This little game of extend and pretend is masking the true health of this gigantic market. And it's gotten so bad that regulators are now taking a very close look. The Department of Justice has even issued explicit warnings about what they're calling opaque valuation practices. Meanwhile, you've got all these classic warning bells going off. Huge funds are literally blocking investors from pulling their money out. Over in Europe, the big banks have just stopped lending to businesses. Instead, they're hoarding 100 billion euros in safe government bonds. And historically, that kind of move, that's a huge red flag that a recession is about 6 to 12 months away. So what happens when these two seemingly separate crises slam into each other? You've got a gas shortage crippling the tech industry on one hand, and a fragile credit market built on shaky accounting on the other. Well, the connection is pretty direct. A tech company that has to shut down production is a lot more likely to default on its loans, right? And that's going to expose the very cracks we were just talking about. Okay, so here is the absolute key takeaway. A single event is creating correlated shocks. See, most financial models assume an oil crisis and a helium crisis are two separate things, but they're not. They are happening for the exact same reason at the exact same time, and that just completely breaks the way we normally calculate risk. What this means is that we just can't trust the numbers we're being shown anymore. Given how fragile things are, the analysis suggests we need to apply a pretty big haircut. That's financial speak, for just slashing the stated value of these private credit funds by 15, maybe even 25%, just to get to a number that's anywhere close to reality. All this uncertainty is also forcing a massive shift in strategy. I mean, think about it. When you can't be sure what a digital asset is really worth, or if the person on the other side of a trade, the counterparty, can even pay you, what do? You see a huge flight to assets you can physically hold and control yourself. So how in the world do you navigate an environment like this? Well, it demands a whole new framework because the old playbooks are clearly out the window. The analysis we're digging into here lays out 4 actions that are pretty much mandatory now. First, a severe stagflation stress test. You have to see how your investments hold up when inflation is high but growth is dead in the water. Second, a direct custody audit, which means physically verifying you own what you think you own. Third is red team validation, that's actively trying to poke holes in your own strategies. And finally, a reserve shift amber alert to keep a close eye on the move away from the US dollar. And all of this leaves us with one last big question to think about. In a world this hyper-connected, where a single choke point can disrupt energy, technology, and finance all at once, where is true safety, really? All right, before we go, just a quick and very important disclaimer. The content in this explainer is for informational purposes only. It is not and should not be taken as financial, legal, or investment advice.